Welcome to our 14th educational segment on commercial real estate. In our previous segment, we looked at EBA, or economic based analysis, to figure out where the employment growth is taking place and therefore where the population growth is taking place and hence the demand for space. But economic based analysis has some shortfalls and therefore some limitations. Limitations such as determining what local areas and more specifically what industries within them are growing faster or slower than the national average and the sources of these changes. This is why we're going to expand on our economic based analysis with the introduction of shift share analysis. I'm your host, Brian Shakarami, and let's get started. In this segment, we're going to continue to look at future market conditions, and we'll try and predict how things might change, and all of this to give you a new perspective on looking at commercial real estate. As you may recall, in our previous session, we looked at economic based analysis, or EBA, to forecast future market conditions. But there are some things that an economic based analysis leaves out and therefore does not tell us. Remember that everything in our universe is relative. If I'm a short or tall person, it is relative to another person. And EBA just stops short of telling us about the relative conditions of a local economy. I said relative condition, but relative to what? EBA doesn't tell us about the current strength of a local economy, nor does it tell us anything about the trends of these strengths relative to the rest of the nation, and that's important. It's important because it matters. So why does it matter? To answer this question, imagine that you are an investor with a stash of cash ready to invest. Are you just going to shoot from the hip and throw a dart on a map and invest wherever the dart landed? Wouldn't you rather invest in market areas that have a very strong growth? After all, that's what real estate investment trusts and institutional investors want and scout for. In the stock market, I always hear past performance is not indicative of future results. But past performance and dissection of its fundamentals can tell us a lot about a company nationally and a company locally, or a local company. So why assess the past performance? It's because the game of assessment is all about employment. And that employment has three fundamental components as follows. There is obviously employment gain. And if you have a gain, then you could also possibly have a loss. And what this loss or gain is attributed to. This is needed to assess the past performance of a company. But how do you assess the past performance of a local economy? The short answer is through shift share analysis. A shift is something that takes place with the changing of time, and the share is what it's attributed to. So shift share analysis measures how the local economy's retail business, for example, is performing relative to the same retail businesses nationally. And it can detect a couple of very important things about the markets. Number one, it can detect if a market is strong despite the presence of declining industries. And number two, it can detect if a market is weak despite the presence of growth industries. Investors look for and demand growth for their investments, and that's a given. And by now, I don't have to tell you that growth is all about employment and jobs. And actual growth has three components or parts to it that we will expand on much further shortly. There is the part that is due to the national growth. There is a part that's due to the industry mix. And last but not least is the part that is due to regional shifts. Let's expand on these. There is a part of the growth that is due to the jobs gained or lost because of the national employment trends. Walmart comes to mind as an example for this. Then there is a part of growth that is due to jobs gained or lost because of market trends in specific industries. Detroit comes to mind on this. And last but not least is the part of growth that comes from jobs gained or lost because of a region's strength. Silicon Valley and Detroit comes to mind on this. So let's put all this together and see what it looks like. We'll start with the actual growth and we will add the three components. So the actual growth is made of growth due to national trends and growth due to industry and market trends and growth due to regional trends. It's important to note that this is a dynamic changing framework. What do I mean by that? Any change in either of these three trends will change the actual growth, up or down. As an example, if all three trends are up, then the actual growth rate is up. Note that you may have a national recession, but certain industries and regions may be doing very well here. Also note that certain areas may be doing very well despite a national and industry recessionary trend. Then again, you may have certain industries and regions bucking the national trends. As I mentioned, this is a dynamically changing framework. The ups and downs of the three growth components has a direct impact on the actual growth. The level of the actual growth increase or decrease depends on how much each component goes up or down. So why would a local economy's employment growth vary from the national average? Why would it be different? And what causes this variance or change? This is where shift share analysis comes into play. And doing it takes three mechanical steps. We'll start with ground zero or step zero, and that's picking our local economy. We will then determine the part of the growth of this local economy that is due to the gravity of the national economy, done by applying the national growth rate for a certain time period to each industry category of the local economy. Then we will determine the part of the growth of this local economy that is due to the gravity of the industry mix, done by comparing the national industry category growth rate to the national overall growth rate. And last, we will determine the part of the growth of this local economy that is due to the gravity of the region, done by comparing the local industry category growth to the national industry category growth. Let's go through it again to get a better understanding. Ground zero or step zero. We start with a local area that we might have in mind. Remember that this actual growth is made of three components. There is a part of the growth that is due to the national trends. We add to it the part of the growth that is due to the industry mix. And finally, we add the part of the growth that is due to regional shifts. And this is an overall picture. We have covered a bunch of concepts, and I realize that things can be very confusing at this point. But you might be surprised to find that they're actually very simple. Once we do an example, we can see all the dynamic frameworks at play and will better understand what shift share analysis can do. As always, let's drive our points home with an example. We'll look at XYZ County, the same location we did our economic base analysis for. An investor has been scouting several areas for real estate investment purposes. They heard that XYZ County may be a good choice, but are not sure. How would you help them determine this? Remember that any shift mandates the element of time. For the purpose of this analysis, we are currently in the year 2019, and we want to look at a 5-year shift. This takes us back to the year 2014 for the start of our shift share analysis. We have extracted the following data from BLS, or the Bureau of Labor Statistics. This is obviously raw data, and we have to make some sense out of it, which means that we have to stick it into a usable, discernible format. We'll start making some sense of all these by massaging the numbers, which means we'll go through our 4 mechanical steps. Ground zero, or step 0, has already been decided. The location is XYZ County. But before we do our 3 remaining steps, we need to figure out what our local and national growth rates are. And to do that, we'll start with employment changes. Remember that a change or a shift has a beginning and an end. The end is the year we're currently in, or 2019, and the beginning is 5 years back, or the year 2014. So we will start with the year 2014. We have the local industry employment categories along with their associated employment numbers. For example, we have 722 jobs under the utilities category. We have calculated that this 722 jobs represents 0.23% of the total 313,245 jobs available in all industry categories of the XYZ County. We've done the same thing for 2019, or the end year. To be consistent, we will use the same industry category we used for 2014, utilities. Again, looking at this sector, we see a total of 750 jobs in 2019. And this represents 0.19% of the total 359,985 jobs available in all industry categories of the XYZ County. Here's a total side-by-side picture of the XYZ County's industry category for 2014 and 2019. So let's find out what the changes are. We will again consider the utilities sector. We see that 28 jobs were added between 2014 and 2019. There is a shift of 28 jobs here. This comes from subtracting 722 jobs in 2014 from 750 jobs in 2019. When we add up all the job increases and or decreases, we come up with a total employment change or shift of 82,740 jobs. From here, then, it is easy to calculate the total or overall percentage of job changes or growth rate that has taken place between 2014 and 2019. So far, we've calculated the number of job changes, their percentages, as well as their overall local growth rate. We must now do the same thing for the national employment numbers for the same categories. Here are the calculated numbers for the same employment categories nationally. And we have, of course, calculated the overall national growth rate to be 12.56%. Now we can run with our remaining 3 steps. Step 1. We'll determine what XYZ County's employment would have grown by had it grown by the national growth rate. And to do this, we will simply multiply the national growth rate by the number of jobs in each category in XYZ County. Here we have the job numbers for 2014, and we'll multiply them by 12.56% overall national growth rate to see what each category would have grown by if they grew at the overall national growth rate. For example, the utilities sector should have grown by 91 jobs had it grown by the overall national growth rate. And the XYZ's overall employment should have grown by 39,350 jobs had it grown by the overall national growth rate. Step 2. We'll find out how the U.S. category growth varies from the overall U.S. growth. For this, we first find the national percent change due to industry mix. This is done by subtracting the percentage change nationally for each category from the overall national percentage change. And once we have this percentage, we'll multiply it by XYZ County's employment numbers in each category to find XYZ's growth share due to the industry mix. Let's look at how this is actually done. We are looking at the percentage of employment change from 2014 to 2019 that we previously calculated, along with the overall percentage of 12.56%. If we subtract the overall national percentage of 12.56% from the national percentage in each category, we will have the percentage of our industry mix. These are the percentages that each national sector varies from the overall U.S. growth. We will then take these percentages and multiply them by the number of jobs in each category at XYZ County in 2014. This will tell us how the U.S. category growth varies from the overall U.S. growth. Take the retail trade industry category, for example. If we had a growth rate similar to the U.S. retail trend, we should have had 6,358 less jobs in 2019. This is because the U.S. retail trade category lags behind the overall U.S. growth category by 12.68%. If you recall, this is how we got that 12.68%. And this is an overall depiction of how we arrived at our industry mix net share. Moving on to our final step, or step 3. We need to find any gains or losses due to XYZ County's local industries growing faster or slower than the same industries nationally. To do this, we have to find the regional shift percentages by subtracting for each category the national growth rate from XYZ's growth rate in the same category. We will then take these percentages of regional shift in each category and multiply them by the same 2014 employment categories in XYZ County. It sounds like a whole lot and confusing, but it's actually very simple. Here's how it's done. Let's recall that we previously calculated the change in employment in terms of numbers and percentages. And here they are. We have them all. This is for XYZ County. Recall that we did the same thing for the national employment from 2014 to 2019, and here they are. Let's place these percentage changes side by side. And here they are for the county and for nationally. The regional shift percentages are then simply the subtraction of the percentages of the national growth from the county's growth of the same sector. And lo and behold, here they are, the regional shift percentage for each category. And once again, these are the percentages of gains or losses as a result of XYZ County's local industries growing faster or slower than the same industry nationally. Similar to what we did with the industry mix percentages, we will take the regional shift percentages in each category and multiply them by the same 2014 employment categories in XYZ County. This to find our share of jobs lost or gained due to regional shifts. Here in blue are the share of jobs lost or gained as a result of XYZ County's local industry growing faster or slower than the same industry nationally. The retail trade category, for example, added 26,440 jobs. This is because it grew 52.75% faster than the U.S. retail growth category. This is a total picture for step 3. Remember that right at the get-go, we said that the actual growth is the addition of three components or parts: the growth or change due to the national trends, the growth or change due to the industry mix, and the growth or change due to regional shifts. We have successfully calculated all three. And here we're looking at a side-by-side view of each of our three components' net percent growth rates and their associated growth numbers. So again, let's look at the retail trade sector as an example. We know that for this sector, we've added 26,378 new jobs. Where did this come from? Well, the answer is that the addition of 6,296 of these jobs were due to the national growth trends. And the subtraction or loss of 6,358 of these jobs were due to the industry mix. And the addition or gain of 26,440 of these jobs were due to the regional shifts. And when you add all these three together, we will come up with 26,378 new jobs net. The same is true for the total percentage of change of 52.63%. Where that came from was a change of 12.56% positive due to national growth, a change of minus 12.68% due to the industry mix, and a positive change of 52.75% due to regional shifts. When you add these three up, lo and behold, you come up with 52.63%. I know this is small, but here's an overall picture of how we arrived at steps 1, 2, and 3. Let's take another look at the conclusions for the retail trade sector. So in conclusion, as an investor, it's extremely important to understand the differences between the local and the national economic growth factors. And shift share analysis examines the sources of these changes in the local employment growth or decline. And it helps to identify local industries that outperform national growth. It's important to note that shift share analysis does not identify what the actual comparative advantages are. It just says that there are some comparative advantages. So knowing that would take a lot more in-depth analysis of the local versus national industries. Shift share analysis does not cover changes in income. It highlights industry categories that are growing faster than the national average using historical trends. It does not point out export categories, as it does not identify industries with location quotients greater than 1, hence giving rise to export categories. This is what the economic-based analysis does. But it does inform us if there are large gainers or losers, which are basic or export category industries in the local areas. As always, if you have any questions regarding anything that we just discussed, please send me an email to the following link and I'd be happy to get back to you. Thank you for your time.